All right. Are you ready?
I'm ready. How's it going?
Doing good, man. What about you?
Doing great. Good to be here. Thanks so much for having me.
Appreciate you being on.
Yeah.
Excited to go back and forth. Got a few people in the chat here, a couple people hopping on. Um, yeah, so I'll give like a short background or what I know of you, and then maybe you can kind of fill in the gaps for people that may not know you.
Yeah.
Um,
Sounds great.
so I had the pleasure of meeting Matt on around the blockchain a couple months ago. We just happened to be on the same show and kind of hit it off. And so he is the author of the book that you see behind me here, Warren Buffett in the Web3 World. Um, he has his Series 65. He's the first registered, licensed investment advisor that I've found that I felt was like really understood digital assets, which I can really appreciate. Most people, they might have some Bitcoin or Ethereum or maybe even know a little bit about DeFi, but Matt, I think he gets the broader scope of things and actually where the market's headed and utility, but he still understands that there's speculation and kind of where we are in the current market. Lots of fun things happening today. So anyway, yeah, if you want to give a little bit deeper background on yourself, and maybe just let the audience know a little bit about you.
Yeah, it's awesome to be here. My name is Matthew Snyder. I am the president and CEO of a company called Block3 Strategy Group. And that came out of a genesis of creating a landing page back in 2021 called NFT Consulting. And I thought, I come from a management consulting background. I was at KPMG for a while. I was over at Slalom. I'm a big finance nerd, so I worked at a lot of banks. I worked at PayPal for a while, and it was just crazy to see like all the kinds of things that happen in both the private sector and also from a banking perspective. And I said, well, it can't be that hard to start a consulting company. And I really liked blockchain tech. I've been in the space since 2016, 2017. I'm a Ripple holder since 2016, 2017. And I thought, well, it can't be that hard. So I created this landing page, and sure enough, people kept calling me. I got art, I got content, I got a coffee house. I want to mint NFTs. I'm like, okay, let's rock and roll. And so that kind of ended up being parlayed into a partnership that I formed with 3 other members, and we sort of absorbed Block3 or NFT consulting into a company called Block3. And the idea was to say, well, we wanted to be thinking of a broader approach than just NFTs. So blockchain and Web3 and everything in between was kind of the way that we came up with this name and a broader range of expertise in the space. A couple of years ago, I got my Series 65 because I thought this is an incredible way to differentiate myself in a space where you can't give financial advice. Now people are like, wait a minute, this guy actually does it. So, we wanted to specialize in the digital asset space. It's a huge passion of mine. And then we wrote the book, Warren Buffett in the Web3 World. So we took like 1,300 pages of his shareholder letters, and we condensed it into a really easy and digestible, snackable investment guide for people in the Web3 space. So the cool thing was to take something that, people think Buffett hates crypto, and he really rightfully does, but his wisdom in the investment space is still very applicable. So we thought, let's put those two things together and bring a little bit of rigor and more ability to grow wealth sustainably for the long term in this space.
Yeah, that's perfect. And for you guys that don't haven't read the book, I would definitely check it out. Big fan of Matt, big fan of Warren Buffett, obviously. We'll get actually one of the mantras for tonight is a quote by Buffett that I was going to bring up. But yeah, I resonate a lot with value investing. Ben Graham was kind of the main person on that, and then Buffett and Munger really took his idea and built one of the best investment firms that has ever existed on that premise. And they're finding good companies or investments that are slightly undervalued or at a fair price. Mm-hmm. And that's where they buy them, and then they hold them for a long time, right?
They called it picking up cigarette butts. Yeah. Because that was what they would do at the track, and they were always talking about handicapping horses and trying to get an edge on horse racing. And they thought, well, Ben Graham would call them cigarette butts. I thought that was interesting.
I mean, it's the unattractive stuff. People, don't necessarily want it right now. It's not in vogue, but it's still a really good business. It cash flows. Like, if you were buying Amazon at $6 after the crash in early 2000s, if you listen to Bezos talk about it, he's like, stock price was garbage, but like everything in the side of the company was clicking along. We were making strides. We were profitable quarter over quarter, and even if the stock price doesn't reflect that, and you're looking at the financials in a company and they look good, and you believe in the trajectory of whatever vertical they're building in, then it's probably a good buy, right? I think a lot of people, and that's where we're at with digital assets. We know that this is like the second inning of a 9-inning game, maybe even sooner than that, depending on what crypto you're in. But yeah, I just think this space is really early and pre-regulation even here in the U.S. And with that, you have a huge opportunity for value investing. If you see things that will be used and have utility later on, you can probably pick them up, the cigarette butts prices right now. What I really wanted to get into tonight and go back and forth on, you and I have resonated on a lot of different things, but one thing recently has been, again, I wanted to talk about Buffett. Number one rule in investing is don't lose money.
Don't lose money. And
the second rule is refer to rule number one.
Yeah, don't forget rule one.
And so, in that, that's not to say that you don't take risks, but you can take calculated risks, right? And you can hedge your bets. You can use puts and options and some other strategic, hedges to offset the possibility that you might be wrong, because we're all wrong from time to time, right? So, we've gone back and forth in this, and Matt's, just to be transparent, we've brought him on as CIO of the RIA that we formed, which is Digital Wealth Partners, and we're orchestrating some really cool stuff that I think we're going to be able to put out in the space and drive a lot of traction for that. But you want to get into, not necessarily the strategy that we're developing, but just kind of speak to the concept of using options as a hedge. Yeah. And really, we're kind of limited. You're kind of handicapped in crypto on the options in comparison to some of the more mature asset classes. Now that Binance is no longer here in the US, you're really kind of limited. Right. So, but yeah, speak to what you can on crypto, and then we can just kind of go back and forth.
Yeah, so I think one of the most important things from an option perspective that people maybe overlook or consider in this sense would be the friend that volatility is to you in options. Keeping things exactly the same, steady state, is not the friend of options. So options are best played when you're engaging with assets that are typically a lot more volatile. And there's typically, for folks that may not know, there's two sides of this contract, right? You can be a buyer of options and you can be a seller of options. The best analogy that I have for this is you can be the buyer of lottery tickets, or you can be the seller of lottery tickets. And that's a nice way to think about it. Over my career, I've found it being the seller of lottery tickets is a way to produce steadier streams of income using more lower volatility assets. And this is kind of, again, in the traditional stock sense, but I want to kind of give a frame before we dive into the crypto side. But the benefit of being a buyer of options is you can typically find very inexpensive or very leveraged, without borrowing money, trades, because each option will typically count for 100 contracts. And so your single purchase is magnified 100 times simply by having that one contract. And because volatility and timing is your friend, the more volatile something is, the more likelihood that price goes up and down, and it can lead to very, very massive gains. If you play them the wrong way or you use borrowed money, it can lead to unlimited losses, which is something that we want to certainly avoid. So always want to exercise caution, especially when buying certain kinds of options in that sense. But on the crypto side, there hasn't been really too many options for people. For people to be able to get access to these kinds of tools. They haven't been really created yet, and we're seeing this with really like new assets like Ondo or some of these other platforms that are now tokenizing treasuries and things like that. We're going to start to see this transition of traditional assets now moving into a digitized space, and there's kind of this convergence of all these pieces together, which is very, very exciting. So once we do get regulation, as you mentioned, you'll be able to see more of these kinds of more of these kinds of financial instruments that come to the table and that people can participate in. But for now, we're a little bit limited. So the best ways that you could, do this right now, because I don't think in the United States you can really short Bitcoin. I think you can do, depending on if you have like fancy VPN or whatever the sign-in kind of way is, you can get access to what they call perpetual futures, which is kind of a very cool thing that they don't actually have in the traditional space, right? It's a perpetual future because the market never closes, which is kind of interesting, and you can keep it rolling. It acts the same as a future, but it kind of never closes, which is interesting. And so you can also take leverage off of that, and that's another sort of volatile way that you can play it. But one of the things that I think is also interesting is now with the proliferation of these ETFs, you now have different vehicles that are being legitimized, and now all of a sudden they are subject to and have access to the traditional market forces. So you can have put options or call options on the ETF. There's now an inverse ETF. I find it tremendously interesting that 9 ETFs got approved and not a single person mentioned the inverse ETFs. I had to like go find this. Like who knew you could bet the ETF on the exact opposite side. So you see this massive rise in Bitcoin and the market in general over the past week, 2 weeks, 3 weeks. And it's getting a little bit frothy. You're getting a little bit of volatility in there. People aren't sure where things are going to go. Now it's an interesting time to maybe look at those as a strategy to deploy in times of high volatility. And that's, I think, kind of a good rounded way to talk about it.
No, absolutely. I don't think a lot of people are discussing this just because, to your point, and mine, there's not a whole lot of options or hedges, ways that you can play this, right? You have to be creative. Imagine if you'd have been able to short Terra Luna on the way down, right? Like the way that you did that was you bought UST, swapped it for Luna, sold it for Tether, and then bought more UST with the Tether, which was supposed to be pegged 1-to-1, and you circled it all the way down the drain.
Right.
People arbitraged that thing until it was beat the dead horse.
Yeah.
And that was the way that you were able to capture, the value out of that ecosystem. And then, I wish we had like a VIX for crypto.
Yeah, that would be really interesting. So, I mean, you'd almost have to normalize it to make it not so volatile, right? Like,
yeah, would it be extreme volatility all the time?
Yeah. It will be interesting to see as they proliferate new instruments into the ecosystem, the different kinds of, I don't want to say market manipulation, but market forces that the tokens and different projects might be subject to that they aren't necessarily subject to now. So when they released the initial BTC and ETH futures contracts, people thought that was going to change the world in the market, and it really didn't. People didn't really care all that much. And England and Europe has had Bitcoin ETFs for like 6 months, a year, and nobody really cares. So it's kind of interesting just in that regard that like sometimes these market forces we think are going to be really powerful, but when people can use leverage or when they can get, like today when we saw a little flash crash of just kind of like frothy nature liquidates a couple $100 million worth of people.
Yeah,
it's dangerous.
Well, if you're on the wrong side of the trade and you've taken leverage, I hope you had an option on the other side, to be able to hedge. So let's give people like an applicable use case here, and kind of talk about, because I could go on ad nauseum about why this is important, but I think for the average person, when they're looking at this, they're gonna be like, okay, well, how do I implement this? So can you speak to that? Like, you said that there's some options on the ETF for Bitcoin. So let's say you are in a leverage long position right now, and I'll just mention this. Nothing here is financial advice. Always seek your financial advisor before making any investment decisions. Entertainment and educational purposes only. So let's say you get a leverage long on Bitcoin right now, and you're crushing it, right? You killed it today. What would be a good way, you know, because I put out the fear and greed index on my Twitter, like right before we got on here, and I was like, this is where I get a little bit concerned. Because we're at 80 on the greed. Okay. Not to say that it can't go higher. I've seen it go higher. So, but this is where I start to go, maybe should, you know, maybe take some profit or put in an option to make sure I'm hedging in case we do get one of those sharp pullbacks that happen in Bitcoin on the way up. Every time on the way up, you get 30-40% drawdowns the whole way up, right? So I guess speak to, you know, what's an actionable thing that people could do, again, not financial advice, just to hedge against that coming, because we know it's going to.
So, one thing before that, I think the greed and fear index is a great way for people to be using or thinking of as an analogy, kind of like an RSI or a relative strength index when they're looking at a chart, right? You see that thing above 75, you always get like a little bit, does this need a little bit of exhaustion to come down in between like a 30-70 range? So I like to think of the greed and fear index as like that. It's like some people, and of course that's a Buffettism too, like that's where we get it from, which is kind of great in some sense, but you do certainly want to be a little bit cautious when you see it flash like all that way. And so that's just one index, that's one sort of trading metric that I like to use and think of as just from an RSI perspective. But back to sort of actionable plays in this space, if you're trying to play the other side, right? So many people will come in and they'll dollar cost average their Bitcoin or their Ethereum, whatever the token is. They're going to put a little bit every month in there. That's great. They're going to keep stacking and hold for the long term. But the challenge is when the market does go in a bad direction for a long and prolonged period of time, it becomes like a big weight on you because you may have overinvested, or you were looking to pull the money out, but now you can't because you're gonna wait for the market to come back up. Like, we've all been in those situations. So when you're thinking about continuing to stack and build, a lot of times people are staking or they're lending or they're earning sort of passive income. That's one way to, again, kind of do that dividend reinvestment program. Like, that's great, but that's not playing the other side. So playing the other side would be saying, for example, I have all these longs and I'm getting, you know, a bigger stack here, but I can also go buy the inverse ETF. I think it's IBIT is one of them, which is the Bitcoin. I think it's the Bitwise one. I'd have to double check. So, and that's just exactly the same. Now, this has to be in a brokerage account, so you can't go do this through Coinbase. So you've got to have something like Fidelity or VanEck, or I don't even know if people have like brokerage firms with BlackRock. That would be interesting. Maybe they do. I don't know. But the idea is that you can go buy these, and they're on just a regular ticker. So they have the same basic fee that the ETF would have, and you don't necessarily need to roll in and out of it on a longer term basis. You can just hold it and pay the fee. So right now, you know, maybe you buy the inverse ETF at $30 a share. I guess it's a share now. We're not talking about tokens, traditional stock market. And what happens is, as Bitcoin goes up, that value goes down because it's the inverse of Bitcoin. But when you see flash crashes, or you see Bitcoin go from 60 and retrace back to 40, that's going to go way up. And now you've got another asset that's betting against Bitcoin with your other asset, which is Bitcoin. Like, okay, continue to stack and dollar cost average. That's fine. But now you've been able to take something off the table, perhaps, because now you've bet against it, and maybe you close that position out because now the market's bottomed and you kind of think you know where you're going to be. The other it's a tough. Yeah, it's the other option.
Hedge is a good word. I like that one.
The other hedge strategy, and this is a little bit more advanced, because the first one is it's just buy the inverse. That's one. Yep. But it's a little bit one-to-one. It's not so much asymmetric. So you're not going to see like a ton of volume go in one direction. You're going to see a little bit of a counterweight, which is good to offset losses. But the other way to go about this is if you take a traditional ETF, the Bitcoin ETF, you can, if you go to like Yahoo Finance, for example, you get the actual thing, and then you go over to the options column and you can see all the available options and all the expiries, and options will be on contracts, and those contracts will end. So there'll be one in March, there'll be one in April, there'll be one in June, there'll be one in January 2024, and they'll all have an associated price, and you'll be able to, in most cases, people buy a call option. That's what happened with Robinhood. Robinhood enabled options. Everybody went on there and they said, okay, green means go up. That's what I wanted to do. And if I buy a put, it's red. It means I want it to go down. So to completely insulate yourself from ever borrowing money or ever being subject to like unlimited losses, you want to make sure that you are a buyer of options. And so being a buyer, it's very simple. You buy the option contract. Maybe it's $100 for the equivalent of 100 shares of that underlying ETF. And you buy the option contract that's a call. That means you think it's going to go up. Well, that's not really the hedge. That's doubling down on what you're doing, right? Like if you're already dollar cost averaging and stacking, you buy a call option, you may have the benefit of volatility, but it's only the upside. So what you want to do is you just want to buy a put, which is the exact opposite, the inverse of buying a call option.
So when we say options too, you're not locked into this. You have the option to execute that if you so choose. So you're paying a small fee now for the option to be able to exercise that later within the time frame that you mentioned there. So maybe it's a month, 60, 90, 6 months, a year, right? That you can exercise that call option at whatever price you purchased it for.
Exactly. And it's like 98% of options never get exercised. So it was originally put in place for farmers to bet on the price of crops or bet on the price of things. I want to buy this at this price 3 months from now. And if it's higher than that, then I made money because I saved what the price I bought for back then versus the price they are now. But now nobody holds on to them and nobody ever takes them. So a buyer of a call option or a put option would have the option to purchase those shares at the end of that contract if they were definitely in the money, if they definitely were profitable. Like, okay, great. If they're not profitable and they didn't reach a certain price, then they expire worthless, and you just paid for the lottery ticket.
Right.
So now all you have to do is think, okay, well, I can go buy lottery tickets for $1 or $5 a piece, but I've maybe put like $100 or $500 in Bitcoin every month. But if I put like $5 or $10 in these lottery tickets, like just a little bit of change here and there on the downside, these options, because they have the magnitude of 100 shares, the price movements that they exhibit along our magnitude are magnified with the price of Bitcoin in terms of volatility, and they can lead to pretty massive gains. And again, you never have to give up the actual token or Bitcoin in this sense. And you can do the same thing. Like you can hold Ripple and short Bitcoin, and the market's correlated enough where you might, and I wouldn't maybe.
I wouldn't say exactly, but I mean, it's a good hedge against it, right? And really the thought. So again, my thoughts here. If let's say you do get that drawdown, you exercise your option. Now you came into a pretty good gain, right? You actually made money on the pull down, which most people, they're just betting price go up. Yes. Like that's what they think. Green good. So if you're doing this, you're probably a bit more sophisticated than I would say like 99% of the investors out there. And this is a hedge. And what it allows you to do is capitalize on opposite movement in the market. So now it doesn't matter which way the market goes, you're going to make money. And if you still believe in these projects and where you're positioned, irrespective of the short-term volatility, let's say you did exercise the option, you made a bunch of money. What can you do with it? You can put it in your long position now at the bottom of where it drew down to and wait for it to go up again, right? So anyway, I just think it's an underutilized strategy. And again, we don't have a whole lot of these options.
There's one like automatic caveat too that you could employ. And so like one practical matter that actually I had to deal with just recently, you have to get permission typically from your brokerage to be able to trade these because they are a little bit more complex. So you want to make sure that you fill out the paperwork, that you understand the paperwork, and that you understand all the risks associated with it. because it is money and it is a little bit more volatile. It's a derivative. It's literally by definition, it's much more risky than holding a stock. So you want to keep that in mind. But if you have a program, I'm always a fan of automation. So the more you can automate, the less emotion you put into it, and the better you're going to do over the longer term. Because the options will expire at a given time, you could buy them 3 months out or 4 months out or a month out and just roll it every month. So even if, and you expect that money to be worthless, like it's a lottery ticket, you expect it to be nothing. So you're really, I mean, it's a barbell strategy. Nassim Taleb does this in a great way. He talks about this, and I think it's anti-fragile. You get 99% of your portfolio in the super risk averse assets and 1% in the riskiest thing you can find. And the riskiest thing you can do right now is bet against Bitcoin on a scale of 1 to 100. So like you can do little bits here and there, but you can just automatically roll it every month. That way you have a consistent hedge on all the time, and that same like 1 month out rule. So no matter when it happens, you'll be ready. You don't have to time it. It's just like, it's like just on automatically.
Yeah. So I guess let's talk about proportion here. Let's say you did want to hedge the drawdown in Bitcoin, and you do expect a 30 or 40% drawdown at some point on the Bitcoin position that you have. What proportion of your portfolio would you keep in the long position to continue to capture the upside there versus, you're going to get 100x on that option. So is it, you're let's say 90% long, or you 95% long, 5% short, or not short, but you have the option?
I've always kind of been a fan of the 595. I think that's going to be a pretty good way to go about it, especially because we want you to be diversified in a way that's a healthy portfolio. Maybe, 95, another 5% should be cash too, right? So we build the optimal portfolio by saying we can take pieces that are still important for the overall portfolio without kind of overweighting it in a highly risky thing. Now, the irony, you and I go back and forth all the time on this, is like, you talk about Bitcoin being like the riskless thing in this ecosystem. Like, how do you have a spectrum of risk and say that like Bitcoin's at the far end of like the least risky it could be? So, it's a brave new world out there, but we're seeing now that this convergence of traditional technology or traditional finance and these digital assets, and now they're tradable on traditional brokerages.
Yeah. And that'll just continue to grow, as we do see regulation come in. So with the derivatives, like, you and I have both gone back and forth on all that. What do you think you're most excited for on derivatives as this space grows? Like, what's going to be when this happens, it's like the cat's meow. Like, I'm pumped that now I have this option.
So I went down a rabbit hole the other day. We had a conversation kind of like on the Tether, what's the situation with Tether, all that kind of stuff. And you talked about, shorting Terra Luna and all that. And I said, I bet there's something on Polymarket that I could go bet against Tether. And I think the proliferation of prediction markets in this space and truth and blockchain technology being a truth mechanism is going to be really, really cool. Because you can go right now, there's not that many shares, but I could go right now, go and it will say, will Tether collapse and file bankruptcy by December 31st, 2024? You can pay $5,000. And if it happens, there's like a 7.5% chance it happens. If it happens, you net like 55K. So
11x return.
And so like you can't go short it right now, but you also can't go put $100,000 in it because nobody's taken that much of that bet. So Polymarket's it's really fascinating to see these markets because there's people taking both sides, and the more volume there is, the more money you could put into an adverse position. And wow. the bigger gain you could make.
So when I talk about the derivatives market, I don't know if I've ever told you my like correlation to real life for people. So this is my example, and this is what the banks do with your money. Okay, like these are the games they play. You're at the Super Bowl. We just had it a few weeks ago. You're in Vegas. Okay, and there's two guys in front of you, and they have a bet on this play. Okay, so not on the game. They've got to bet on this play that a flag's going to be thrown. And we'll say it's $1,000 bet between two guys. You're standing with your buddy and you got your other friend over here. You ask your buddy for $100. Okay. He lets you borrow the 100.
Mm-hmm.
You turn to the other guy and you say, hey, I bet that guy punches the other guy when he loses the bet, and I want 100x leverage on this 100 that I borrowed from my buddy. That's the type of stuff.
Yeah. Micro bets.
Right.
Yeah.
And then they'll take an option on the other side of that bet with another 100 that they borrowed. Right. So anyway, that's my example for derivatives in the real world for people.
Oh yeah. And I mean, for, most people are, aware, like, this was the thing that led to sort of the financial collapse, right? Like, derivatives are made up of things that are not the actual value, and option contracts are the derivative of a stock, but they have their own contract value, and that contract value is worth something at some point or nothing at another point. Right. Also really interesting about, I don't know if you heard about this bet that the streaker made. So the guy at the Super Bowl placed a bet in Vegas for $50,000 that there would be a streaker.
Oh, and then he was the streaker?
And then he was the streaker, and he netted like $500,000. $525K, and then the total fee was like 12 grand.
Wow.
He spent like the night in jail as a $12,000 fine, and he netted like $500,000.
Perfect. Yeah. I mean, how can you fix it? How can you know that it's going to happen?
I was like, it's fantastic.
Well played. Yeah. I mean, if you're cool with a misdemeanor or whatever that ends up being, like, to make a $500,000, everybody's got their hustle,
Also $500,000, like, a really smart way. Like,
yeah.
I don't really want to fall on my face and find $500,000. I mean, I would, but it wouldn't be nearly as cool of a story. It's like, how'd you get this car? Oh, I gotta tell you.
Yeah. Put, I bet on myself. Just
yeah.
Other people bet on their business and bet on themselves. I bet on myself in a very different way.
Fantastic.
Well, yeah, man. So I guess let's expound on derivatives for people. And I'll tell you about a project that we're working on and what I think is going to be really cool. So this is a weird concept. Okay. So like I talked about a bet on a bet, like, the game itself is the underlying value that everybody's watching. And the people in front of me have a bet on just one play or one piece of that. And now I'm betting on their bet going bad a certain way with borrowed money and taking leverage.
And leverage.
And that's so the underlying collateral for all these derivatives has to be U.S. Treasuries, has to be tier 1 collateral. But they just borrow it and rehypothecate the same treasury over and over and over again, up to like 10 or 15 times. So when we're talking about derivatives, though, like paper gold or the forward contracts or different contracts on underlying assets, that is a derivative. So it's like the second layer. This is the underlying asset, and like you talked about, an option. So, let's say, so I did industrial sales for a long time. I'll just relate it to that. I worked with people that produced food products. Okay. And they would buy contracts for 6 months or a year or options to purchase corn at a certain price. Okay. Because they didn't want volatility in the cost of their product. Otherwise, they'd have to change it for you at the supermarket every other week, right? Like if corn was up $1 compared to last week, well, now your corn's way more. You don't want that, right? You don't want the swings in price of your cost and then have to pass that on. So that's a derivative. It's just another contract on top of whatever the underlying asset is. So the ETF would be a derivative of Bitcoin, right? It is a share of an exchange traded fund that owns the underlying Bitcoin. It's one layer removed.
1-to-1.
Yeah, right. And then you have futures. So there's a lot of different ways that you can bet these contracts on the underlying asset. What I'm excited about and what we're looking to do and hopefully this will be available in the mastermind, should be, is we're looking to create an SPV that allows people to invest their XDC into an SPV that then allocates that to a master node where they're able to earn 5 or 6% yield. Because right now, you're just holding it. You're hoping for price appreciation. Great. But unless you have 10 million XDC, you can't earn any interest. And then even if you had 10 million XDC, I have clients that do. If you don't know how to run a validator on a network and how to spin up the infrastructure and participate, you can't make any money with it, right? Aside from the appreciation.
Seed phrase is hard enough.
Yeah. I'm not that guy either. I got really good people around me, okay? And so with that, imagine you're able to make the investment in this SPV. You own a share of the validator or node for your contribution of the XDC. And now there's a secondary market where you can trade the interest in the node. What is that worth? Because now you've got to depreciate cash flows back because you're going to be receiving those distributions on a monthly basis. 0.5% a month is what you're going to get, right? Of whatever you invested. And then you're going to speculate. People are going to speculate on price appreciation over the term of the contract, right? Yeah. So let's say these are locked up for 3 years, but after the lockup period, which would be 90 days or a year and a day, you could sell it on the secondary market. And maybe at that point, you've got pension funds, you've got other institutions that now want access to reoccurring revenue produced by smart contracts and blockchain, a staking pool of some kind, because they understand that it's sustainable at this point.
Yep.
So what are they willing to pay as a premium on that contract, right? Well, you might speculate that it could double or triple over the next 2 years, and you've got to discount those cash flows back that are going to compound. So that's where this stuff gets crazy, is these types of...
And even like one further like piece of this is that one asset could be its own set of a derivative within some mortgage-backed security or some other piece. Like now they're just able to slice and dice and put things together in a way that like it's just a Frankenstein of a security. And they can sell it. It can give you 17% APY, and nobody can tell you where or how they do that.
Well,
but like Celsius, it just shows up in your bank account.
But if it's all on the blockchain,
yeah,
and it's immutable, and you can verify all of the income and where it's coming from, then it's completely transparent. And that's where we're at with the derivatives market. That's why nobody can quantify how much exposure these banks and institutions have, is because none of this stuff's on the blockchain. None of this has been tokenized. And so they, Lehman Brothers and Goldman and everybody had all this exposure in 2008, and they knew they did, but they didn't know how much, right? And so when things started to go bad, and so let's say in that same example with, me taking the leverage, betting on this, on the game, they're betting on the game. In the middle of the play, the screen goes black. Now who wins? What happens, right? That's like 2008 with the underlying collateral going bad. Everybody had built all these other bets on top of what was supposed to be AAA grade credit backed mortgage securities, which were ninja loans. Okay.
And nobody went, what happens when they don't go the way that we think they're supposed to go? Right. They only go up, right? We wrote them in green ink. They only go up.
We can print more money. It'll be fine.
Yeah. Oh, it's fine.
So anyway, that's the crazy part of it. And that's why, the derivatives require the premium collateral to be able to participate, is the whatever you're using as collateral to back your bet has to be stable. Like they have to know that that's good to be able to cash, because if it falters, we got to be able to collect on that for you to be able to participate. So anyway,
it's pretty scary too, like just from like not like an ethics perspective, but it is weird that, I mean, there was a kid who was probably, I think he was 19 or 20, and died by suicide because there was a two parts of an option trade that Robinhood didn't settle correctly.
That showed you
and they
lost
had
like $7 million or something.
yeah, some like astronomical number. And if he would have waited the next day, the next market day, it would have settled out. But like that like this T+2 nonsense is really terrible. And like we need things settled like right now so that that stuff never happens and that it can't ever be like reversed. But it's like it's kind of, they gamified it with Robinhood, and there's a reason why people shouldn't be trading options, and they just made it possible for people to just buy like lotto tickets. But they also made it possible for people to learn about it, which I think is important. And they did really good job of like educating you about it, but they 100% gamified it to make it look like, you know.
Well, and this kind of goes back to the accredited investor test, right? I wish there was some type of certification or something that you would have to take in order to prove. And people will cheat, right? Like people cheat on every test. But for the majority of the people, if you did take the time to learn whatever it was, you would be prepared and you would understand the risks that you're taking. And that's really what an accredited investor is in my mind, is you completely understand the risks that are associated with your investment, and you're willing to take those risks and make the investment. And so, but if you're retail or you're not accredited, and I think a lot of people that qualify as accredited don't really qualify as accredited under my criteria. They probably still don't even understand the risks that they're taking, nor do they really understand all the disclosures and that they're making those risks. But they have enough income or extra net worth that it's a cushion to save them if they do make some poor choices. And that's really what the SEC is using at this point to kind of mitigate those risks or problems, is that, okay, well, they'll make another 300,000 next year, between the married couple, or, if they lose $500,000, they've still got another $1 million outside their primary residence that they can fall back on. They'll be okay. They're not going to be homeless tomorrow. But anyway, I'm hopeful that there's some type of certification or tests. And I think, if exchanges, or not exchanges necessarily, but brokerages were responsible, they would, have to verify. Like you took the 65 and pass. There's a lot of regulatory compliance that's on that test, and really how you report with FINRA and the SEC and all of the forms that need to be filled out and disclosures that need to be made. And about 25% of that test is really on like how to invest people's money. 75% of that test is on the regulation.
It's like two questions that are like, what happens when inflation goes up? And you're like, but like the rest of it's like, the rest of it's like all legal stuff.
Yeah. So then, and they've made that test the other way that you can be accredited, which is crazy to me.
That's right. I forgot about that.
So yeah, you can take a 65 and then you get sponsored by a broker, and then you have to maintain the compliance that goes along with it, which I'm sure you're doing on a regular basis. Continue education, all those things. You can maintain your license. And then you also have to report every quarter your investments to whatever regulatory body your broker is governed by, right? So if you're managing less than 100 million, that's going to be the FinCEN. If you're over 100 million, it's going to be the SEC. And all that, like some people are willing to do that just to be an accredited investor and be able to invest in private equity,
right,
with their 5 or 10 grand that they have to be able to bet on something to get the upside on an asymmetric bet. So these options, I guess, in that sense, actually provide you a really good way, even if you're not accredited, to get exposure to an asymmetric bet.
Absolutely. And it's, it is also interesting that it's a barrier to so many people, because I feel like people can go into a casino and throw their whole life savings and on the craps table and bet it all on black, and casino's like, come on in, we'll give you a lobster and the bed for the night. That's fine. That's what you get. But like, oh, you want to invest in this company because it's a startup and it could go bad, and you want to put 5K in there? Like, no, you have to make this much money. Like,
can't do that. Yeah.
No, we wouldn't want you to get hurt. Like,
yeah, it seems kind of backwards, but hopefully we can rectify that. I think we're on the path. I think a lot of people have brought this up. It's a concern that a lot of people are discussing. And so when I spoke to Hester Pierce 3 weeks ago, that is on the docket. It is something that they're looking at and something that they're working toward. And I think, I don't know that you could, there might be different, like, so for the options, as an example, in order to be able to do options, you should probably have like a 20 or 25 question test. And if you're able to knock that down and get an 80 or higher, you probably do options, right? Same thing. Maybe it's investing in real estate, whether it's commercial, residential, wholesale, short sale, flips, all the different things that go on there.
And I'll tell you, it's way too easy. It's a couple pages you have to print out. You can't do it online. You can't call them. You have to give your social, your name, your address, and then it has to say like, what investment risk are you most interested in? And they won't give you options unless you say most aggressive. They have you five options. If your answer isn't this one, no options.
No options for you. So very aggressive, high risk tolerance.
Yeah. And then it's like, how many years have you done this? And if you don't have like at least 2 or 3, if you like, I'm brand new, they're going to be like, maybe not.
Well, and that's probably important. Good, right? Because again, for the average person, unless they really do understand the way to use this as a hedge against their other investments, you could have unlimited losses if you do the wrong thing. So
yeah, and I always like. I love Webull as a trading platform for paper trading. So if you want to get to know about options, there's a ton of online videos and stuff. I'm always happy to talk about options. I love the sort of concept of them. So always happy to chat about it, but like paper trade them, learn how they react, learn what the time difference does, because they're so affected by time. The price of them goes up and down dramatically based on how much time is left on that contract. So I encourage people to try it out and play with it and see and get more comfortable with it, because once you put the training wheels on and you kind of figure out what and how it works, then you can actually put real money into it and not be freaked out when stuff may or may not go your way. So that's always a really good way to play around with it. And they have a really good paper trading options platform.
Well, and we talked about like 95.5. I think, again, not financial advice, never is, but if you're doing asymmetric bets, you don't have to put your whole life savings on something, right? If something has 100x to the upside potential, if it hits, it's a lottery ticket. Like you don't go out and spend your whole paycheck on lottery tickets. You know what I mean? You might throw a 20 at it and be like, all right, well, cool. If it hits, quit my job Monday, good to go. But if it doesn't, going back to work.
Yeah, you bet red or black and then on green. You don't bet red, black, and green. You bet one or the other, and then like you put a little bit just on that one.
Just in case.
Just in case.
And if it hits, then you're good, right? Yeah. So we had a few questions in the chat here, and we've been rambling on for about 45 minutes. You're good to have some Q&A?
Yeah, that'd be great.
Okay. So we got one here that was early on. And this is from Pay Me an XLM. Avid viewer, appreciate you showing up as you do. He says, can we get a brief overview of RWAs for NFTs? Safe travels. Yeah, I'm headed to Dubai this next week, so I appreciate you on the travels. So yeah, would you run down? I think that we're going to have tokenization of equities in companies and trading of digital asset securities before we have tokenization of the underlying assets. What do you think? What do you think comes first? And yeah,
I think it's a great question. I know we know that real world assets are going to be sort of the next big thing. You had this great Mark Yusko quote where he's like, everything you think is going to be tokenized. Like you look at it, it's going to be tokenized. And when we say tokenized, I think a really good way to think about it is fractionalized, right? Like we break it down into tiny bits, and then we own those little bits. So, I have this dream of being able to tokenize my house in a way where I could have a QR code outside of my house and people could buy equity in my house instead of me taking out a home equity line of credit. So they could have 5%. I want to give up 5% of my house as my equity. And they can't do anything with my house. They don't own it. But when I go to sell the house, now they have that NFT or that contract. And that's really what the NFT is used for from that perspective of tokenization of assets. It's not a JPEG. It could be. I mean, it could look like a JPEG, but it's not meant to be a PFP project. It's not meant to be anything art or content related. It's meant to be a deed or like a security of ownership. Yeah. And that's one of the benefits of NFTs. Like one of the real world use cases of them is to be able to tokenize and have deeds or ownership of fractions of large things like a car or a painting or a house. And that's going to be incredible. And then you'll be able to put options on that and derivatives on those.
Yeah, that's when stuff gets really crazy. But it's all trackable and traceable because it's on chain.
Yep, absolutely.
Right? And then everybody knows what the exposure is, and they can mitigate those risks. And we don't have another GFC.
Yeah, right, exactly.
So, yeah, I'm with you. I'm excited for. And the other thing I would say to this, the assets that are worth the most will be tokenized first, in my opinion. Mm-hmm. So everybody gets real estate, like everybody and their mom. When you say NFTs and they understand, you know, what you just talked about, the deed being tokenized, the ownership in the property, and the fractionalization, that's like the first thing they go to. They're like, oh, all of real estate is going to be tokenized. I do think so. Caveat. I don't know if you guys have ever seen the title transfer process and the county and how they keep the titles and the deeds to the properties. But it's in a filing cabinet.
I was going to say.
and Bertha down there, yeah, at the county clerk's office has worked there for 35 years, and she knows right where Grandma Ethel's deed is over there in the cabinet. Okay, barely in the computer as it is. So for that to get on chain, we're 10 years out.
God forbid that place burns down.
Right.
Single point of failure. Single point of failure. No good. No bueno. No bueno.
Not decentralized in any capacity. No copies. Hopefully they have copies. Surely they have copies on a server somewhere else at this point. They've mitigated some risk. But anyway, my point being, there's just a large hurdle there for the majority of society to adopt this technology. And for somebody to develop a solution that has an oracle that can pull that information on chain and have it be fast, secure, and easy to use, hopefully somebody's out there developing that. Like if it's you, holler at me. I would love to hear about your project. But yeah, I just think that the derivatives are actually what's going to be tokenized first. So like I talked about SPVs, I think that, you know, a company that owns an underlying asset, you could tokenize the shares in that company and trade those in a completely transparent, regulated manner long before the actual underlying assets will be tokenized. So even though that is coming, I think, you know, Mark Yusko is right. Everything of value will be tokenized on chain. It's just
you'll never know. Like when it gets to the point, like there'll be markets for it, but you'll never really know that stuff is like tokenized. You'll just say, I want to buy this, and it'll be on Robinhood, and you'll own 5% of somebody's house.
Grandma will be able to do it, you know, and they won't. That's the other thing. People won't care about the technology or how it happened. You don't know about the HTTP protocol or the email protocol or all the other things that the internet requires in order to be able to facilitate transmission of information. You just want to be able to get on a live stream with your buddy and have a cool conversation in front of a bunch of great people, and it work. You know, and somebody else figured out all the all the stuff for that. Let's see here. Appreciate you being here, Rick. A lot of good people in the audience tonight. Maddie G, not the infamous Maddie G that had Quincy on first. This is a different Maddie G. Even I like Matty G though. He asked if we're going to be in Vegas. I don't think so. I don't think I'm going to make it this year. When is it? We'll see. That might change. What about you, Matt?
When is it?
It should be like May 3rd and 4th this year.
Maybe I'll.
MGM. Tickets have gone up substantially. Compared to last year, and justifiably so.
Bullish.
Yeah.
All right.
You know,
They don't need me there.
maybe by May, XRP will be, you know, a lot higher price, and everybody will be able to afford to go. And I'm just weirded out about being in a public place with a bunch of other people that may have a lot of money and drawing attention. You
I
know,
think that's a very valid concern and thing to be observant about. I think that's
yeah,
very valid.
yeah. I don't mind getting up and speaking in front of people. Obviously, I like doing that, and it's part of my mission. You know, I wouldn't be able to accomplish the things that I'm looking to do if I wasn't doing that. But if I had my choice, I would remain very private. So anyway, that's my 2 cents on that one. I think it's going to be a great event. You know, Brad and DAI and everybody else is going to be there. I'm sure it'll be a great time. They got David Schwartz speaking.
Nice.
And I think they're diversifying a little bit, maybe bringing in some other crypto projects and different people from the blockchain space. I think Deaton will be there. So, but I don't know. I'm still up in the air on it, but I'm leaning towards no. Max says whiskey cast tokenization is interesting. I mean, I'm up for some tokenized whiskey.
100%. And they already kind of do this at some, I think,
Yeah,
not wineries, or you can own like part of a casket, but you have to be like a member and all this kind of stuff.
like a cow. You go in with your buddy
Yeah.
on a cow, you know, and you get however much meat.
Right. Oh, okay. That's what I was like, okay.
Yeah,
Or
yeah.
like a
Well,
horse.
you know, it's Texas. You know,
Yeah.
I'm sorry.
Forget.
Let's see here. King George says, or George Klug says, you will own nothing and be happy because we will tokenize everything and invest everything in everything else. When will it stop? You get an asset and a loan. You get an asset and loan it out. Well, and that's, you know, so what the wealthy do. That's the game you play, right? And as long as taxes and the considerations there remain the same, loans against your assets are not taxable. So
we've got an interesting situation where we're going to start a new project and we need some seed money for it, but it makes a lot more sense to not sell the crypto because that would be a big taxable event, especially if you've had Bitcoin in the teens. So you're like, I'm not trying to get rid of that. So why not just take a small little loan out, pay a little off the top, you know, little rental fee, nothing wrong with that. And then you completely avoid 20, 30% on a taxable transaction.
Yeah. And that's how you do it, you know, and as long as the interest rate is less than the 20% you'd pay in taxes.
Yeah.
I mean, and the other caveat there is, you know, hopefully you're using that capital to put it into something that's going to generate returns beyond the interest rate.
Exactly.
So as long as you're making a strip there and you're able to service the debt, and that's where a lot of people are in trouble right now with the illiquidity and the spike in rates, is they made bets that, you know, loans were going to stay long. You know, they took out a lot of leverage at low interest rates, and now they got to refinance that, and they can't service the debt. And so people are in positions right now where they're stuck and they've got to liquidate, and you know, that provides opportunity for other people that are well positioned. So if you guys have any questions, you can run it up here in the chat, and we'll hang out for a little while, maybe another 30 minutes here. Matt's on the East Coast, and I want to be respectful of his time. I know he gets up early like me, so
yeah.
Mark Phillips, thoughts on when we'll finally have regulatory clarity in the U.S. You go first on this one, Matt.
I'll give you a great anecdote. So Amazon was shipping things to your house as early as like 2001, 2000, you know, and they were starting to be more than just books. We didn't get regulatory compliance or rules about how you tax those until 2014. So it was a long time before we even figured out how to tax the sales tax, where you bought it from, who it came from, who was taxed where. We didn't have those regulations for like another decade and a half. Yeah.
So the states, I didn't even think about that,
Mm-hmm.
right? So Amazon, where are they incorporated? Are they selling it from, is somebody on their platform selling it from a certain state?
Yep.
And somebody else is buying it in a different state.
Mm-hmm.
And so what are the taxes? See, I'm in Texas again. I don't have to deal with state tax. So yeah, I mean, that's a definite consideration. I didn't realize. So what you're saying is, Bitcoin's been around for 15 years. So it's about time. Like,
Well, I would really say it's only been taken seriously in like the past 5 years or so.
yeah.
Yeah, it was kind of a passing fad. I mean, not a passing fad, but it was kind of like this under the radar thing that nobody thought was going to do anything. And now they're like, oh my God, we have to figure out the rules.
It's $60,000 again. Like, what are we going to do? Yeah. And there's ETFs on it. So got to do something.
And there's options on it.
Got to have some type of clarity.
Figure this out.
I don't think we're going to get regulations on the entire crypto market until 2025, 2026. It's my guess. Glad to be wrong. Don't have a crystal ball.
Yeah, I don't think you're going to see anything this year. It's gonna happen after an election cycle, if at all. So yeah, it's gonna be a little bit of time. But they've certainly put the regulations in where like they can stick it to the crypto space best, right? Like you can't do this, you can't do that. But we don't know what some of these other things are, so we're just not going to do any innovation, or we'll just punt.
Yeah, I'm with you. I think we're going to need somebody else to come in office, and that's going to need to change. And then there'll be either one of them that'll be their last go, right? So that's on the assumption that Trump gets nominated as the Republican, representative, and Biden stays as the Democratic option. I'm agnostic. I don't think it matters who's in there. I think what's going to happen is going to happen irrespective of whatever person they have in the White House. Just my 2 cents. But I do think the caveat to regulation on the whole crypto space, I think we're going to get stablecoin regulation this year here in the U.S.
I could see that.
And that would provide clarity to stablecoins, obviously. So Tether, USDC, DAI, PayPal has a stable coin. There's a lot of large enterprise businesses and fiduciaries that have a stable coin, JPM coin. And I think we'll also get with that clarity for XRP and XLM as bridge currencies, because that's the determination or the nomenclature that's used in that legislation that's currently proposed. If it's not changed, could be changed before it passes the Senate and Congress. So that's my speculation. We get stablecoin regulation in the first half of 2024, and then it's probably 25 or 26 before we see full regulation. And what I want to see, and for NFT's sake, is that NFTs are legislated as ownership and recognized as the title or deed to a physical item. Until that happens, tokenization of the underlying assets is not going to happen. You have to have legal clarity around that represents ownership and is legally binding as ownership in whatever it's supposed to represent. So
you think we'll get an ETH ETF or an XRP ETF?
I think both are very likely. We actually already have an XRP ETF for people that don't know.
Oh, I didn't know that.
It already exists. There's one that's on the market. You can invest through your stock portfolio in XRP. Grayscale removed it from their trust when the lawsuit happened. They haven't reinstated it, but they've added it back to some of their funds. So you can get exposure through traditional assets, but it's kind of niche stuff. Just like you mentioned before, you got to go looking for it to be able to find it. But it is out there. Now, BlackRock, that's the one that really matters, I think, on the ETFs. Is a BlackRock ETF for Ethereum or a BlackRock ETF for XRP. So yeah, Larry Fink kind of made a weird gesture about that for XRP and ETH. So definitely, I think it's more likely than not.
Yeah, I think so.
Let's see here. This is a good question. Eddie says, or Edward says, hi guys, if Ripple owns the ledger, why would they allow other tokens to use it? Just keep it for X tokens. There's a lot going on there. Ripple does not own the XRPL. It's a completely decentralized solution. There's people that are validators on the network that vote on amendments outside of Ripple. Ripple runs 3 validators on the network. There's 35. It is a decentralized network that they leverage in order to facilitate settlement of payments and offer solutions to the banks and fiduciaries they work with. So they don't own the ledger, and you can issue any assets you want on the XRPL. You can wrap another token on the XRPL. So, and people may not know what that means. So let me break down what a wrap token is. You're going to lock that in a smart contract on whatever network it's issued on, and then you're going to issue representation of that collateral onto the other network.
It's a derivative.
So that wrapped token is going to have the same value as whatever the token is on the other network. Otherwise, people would arbitrage it until it was the same value. So if you have wrapped Ethereum, it might be staked somewhere in a pool, but you could have representation of that somewhere else and be able to trade it. And it provides liquidity to assets that may be locked up for whatever reason.
Well, and like one really good example is wrapped Bitcoin, which is an ERC20 token and can be staked because you can't stake Bitcoin.
Right.
So that's a nice use case.
Yeah, it adds an ancillary utility or benefit, or you can do other things with it that you wouldn't be able to otherwise. Right. So that's the benefit of wrapping tokens on another network. You've got Flare networks, which had Doge and SHIB and Algorand and obviously XRP, and there's a ton of stuff that they were supposed to be able to mint F assets on that network that hasn't launched. It's in beta. I'm hopeful that it does make it to market. But anyway, yeah. So you're not going to have other X assets like XLM and XDC moving on the XRPL unless they're wrapped representations of those tokens that would then still be settled through XRP, which is the native asset to that network. And then you might have wrapped XRP on XLM, which would then be settled in exchange for something else on that network that's an issued asset through XLM. And XDC works the same way. It's the native asset for XinFin. So hopefully that gives you a little better clarity around the question. But yeah, did you have any?
No, it's helpful for me. It's always you're much more into the XRP ecosystem than I am, so it's a great education.
Sorry.
No, it's very complimentary. Like it's great to not know about something and learn about something.
Well, yeah, you've got the NFT side of stuff down that I, what was the shirt you were wearing the first time I saw you on?
The Coda, other side Coda on there.
Yeah. So the lands of the meta and all of the different things that come along with those that you can then like break out. So like you can have a Coda with a weapon, and that's more valuable than just with the Coda or just the land by itself. And so anyway,
it's been crazy.
Pudgy Penguins is another one. For you guys that don't know, my hookup, my NFT guy besides Matt told me that's where things are headed. The Pudgy Penguins on Solana.
I want to get you some stuffed animal. Get you some stuffed pudgies.
Put it back here. My lion. What are we gonna do with the lion, man?
Fractionalize it, tokenize it. It's made of gold.
Well, it's spray painted gold. It was black. I'm just being real with you.
Appreciate that.
Maybe an excellent says, anything new, interesting news you have on XDC? Thoughts on why New York, Texas, Hawaii, and LA being disrupted? Maybe that was for the Coinbase thing earlier today. Not sure.
Maybe that was. Oh, there was also like cell phone outages. I don't know if that has anything to do with it,
Oh
but that
yeah,
was like
like
a
a week
big
ago,
deal.
AT&T. Yeah, maybe that's what he's talking about too. I
Mhm.
have no idea on the disrupted point. Pay me an XLM if you could expand on that or give me a little bit more context. Um, New interesting things. I made a video about plugin the other day,
Oh,
which is an Oracle that's they're agnostic. I learned afterward. People jumped my ass for that, but they're building it on XDC's network specifically for XDC, and then they want to make it agnostic
hmm.
in the future. But I think there's a lot of things in that ecosystem that people are thinking about. You got some tokenization of some real world assets there. I actually meet the founders, Tool and Ritesh, next week.
Cool.
They'll be in
Nice.
Dubai at the USA UAE Alliance. Crescite is affiliated with that, and they're another token that's on that network, which is doing some pretty cool stuff. It's only been sold to accredited investors at this point, so pretty buttoned up project. But might look at that one if you guys haven't heard of that. It's a lot better than Jesus token. I'll just say that.
Jesus coin.
Yeah, excuse me, Jesus coin, not
Don't you
Jesus
know
token.
anything?
No, not on the meme stuff. I'm out. Um,
For you, good for you.
let's see here. Thoughts on subprime credit cards and rebuilding credit. No longer have long-term girlfriend. Loan based on gift that keeps giving. Ah, poor guy. Lone Wolf. I see why your name's Lone Wolf. Um, if you know, if your credit has gone down, your credit history is actually one of the biggest drivers of your credit score. The longest line of credit that you've had open. So if you can get added to somebody else's credit line that's had a really long credit line, it can really help your credit. Obviously, they won't want to give you access to be able to use that credit line, but if you're at least on there, helps you out a lot if somebody's willing to do that. These are some of the hacks. If you do have a business, you can you want to make sure that you have a DUNS number associated with that, and you can build that credit a couple different ways. I'd get some gas cards. Your credit score itself is going to have to be decent in order to be able to apply for the credit cards for the business. So you're going to build up that first, and you can do that by getting like collateralized credit cards. So you get a line of credit at your bank, you go deposit like 10 or 15,000, you can draw a line of credit against that. They'll charge you some interest, pay that off every month, do that for a year. I know. And this is the problem with credit too. Once it goes bad, it takes a long time to get it fixed. But if it's good, it really doesn't take that long to mess up as soon as you miss one payment or you don't pay a card on time and it reports at a higher credit threshold. They like yank your score down.
Oh yeah.
Diversification in credit matters some. So if you've never owned a vehicle, had a personal loan or credit cards or a mortgage, all those play in. And the larger the loan that you've been on, the more money you will get loaned, which seems ridiculous, right? You're like, well, how do I get a bigger loan if I've never had like chicken before the egg? So again, that's one of those things where like if you're going to get into flipping real estate or if you're getting into, commercial real estate of some kind and you're financing a $10 million property with $3 million down, you're going to go raise it. You're going to need a partner that's had a loan that big before.
Yeah.
And then once you're on the loan with him, you guys pay that off after the 3 years. Now you're good to go. The bank will go, oh, you've already had one of these before. You paid it off. You're good. But until you have that under your belt, it's hard. And other things you can do for your kids too. So there's actually companies now where you can take cards out for your kid at any age.
Yep.
And as long as you're responsible with your credit, it builds their credit. So like I talked about, your credit history is like the largest piece of your credit. So if you could give your child a gift, I wish my parents had done this for me. If you're responsible, don't ruin your child's credit. But if you are responsible and you do have good credit, again, not financial advice, I'm just throwing myself under the bus here. But if you go add your child on your credit card, it'll build their credit history as long as you're going to keep that card open. And then, when they turn 18, maybe they have an 800 credit score if you have taken really good care of your stuff. And then they can go finance a house or a business or get access to lines of credit that they otherwise wouldn't be able to. So just some thoughts there. I've rambled on a lot on that, but yeah.
I have two that are also good. So one is your credit is a factor of how much money you are eligible to be lent. So one nice hack, just call the credit card company and ask if they can raise your limit.
Yeah.
If they raise your limit 10K or 20K, it helps you get the potential of having more money, and that raises your score. The other thing too, from the car business that I learned was so a lot of people don't like to lease, and I get that, but leasing is an interesting credit hack because when you pay off a lease, it equals one paid auto on your credit loan.
Really?
Yeah. So I could have a 2 or 3 year lease and I could pay that off 2 or 3 times the same amount of time if I had a 6-year loan. So now I have 3 paid autos or 2 paid autos in the same amount of time than I had 1 paid auto. And I don't know, but I think 2 is better than 1 and 3 is better than 1. So,
or you can be like me and you can finance cars and wreck them and just have gap insurance, and then it covers the note.
That's right, gap insurance.
I did that in my early 20s. I was going to school and working full time and trying to work out and sleeping 4 hours a day. And yeah, anyway, don't do what I did. Do what Matt said and get the lease. And if it's not over 6,000 pounds, lease it through your business and write it off. If you can't get the depreciation on it, you want a Lexus or a BMW or something like that. It's probably the better way to go. Anyway, a great topic there, Lone Wolf. It was like way off in left field compared to what we were discussing, but I think there were some nuggets there for people.
Yeah.
So credit utilization low. Yeah, you want to keep it below. Really, like below 5%. And the hack on that is you'll figure out the reporting dates for your cards, and it's normally a couple days after your payments are due. That's how they get you. So you want to make the payment on time, and then wait till it reports, and then start using that card again. That way, it will report at 0. So, and then you can run it up, pay it off. Same cadence. One thing I will mention there also, if you are a veteran or you have a veteran in your family, Navy Federal, fantastic for personal lines of credit and business lines of credit.
That's good to know. Also credit unions, like local credit unions.
Yeah. Well, that's what they are. Navy Federal's a credit union, but yeah, they you tend to get better interest rates through a credit union than you would a normal bank. Turnout says, when opening a business bank account, most banks ask for an operating agreement. Should crypto be included in the operating agreement? This is a great question. And the answer is tear that capital contributions page off the back of that sucker before you give it to them. Okay. Put the whole deal together. You list your crypto on the capital contributions page. They don't even need to know that exists. It's notarized separate. You're gonna list something else in there for the value that you provided, and hopefully that's dollar denominated. They're never gonna know as long as you don't give them that capital contributions page that shows your digital assets. And then even if you do, half the time they're gonna look at it and go, "Oh, these are account numbers somewhere else," because they don't even know what crypto is. So unless you list BTC on there or ETH, they're gonna be like some other kind of statement. I don't even know
what's dog with hat.
DOGE.
Currency at another country.
Yeah, they're not going to know. But yeah, that would be my recommendation. Just since it's the last page in the operating agreement anyway, most of the time, I would just remove that page, take it in without it, or send it to them. Have a version of it that's a PDF that doesn't include the capital contributions page for when you're dealing with banks. Let's see. Edward says, thanks for the explanation. So you needs XRP to run every token. No, XRP is just another layer 1. All of these other tokens can operate as native assets on their own network.
Mm-hmm.
However, I do think that there will be a lot of issued assets on the XRPL, and because of the liquidity that'll be in that ecosystem, it might be advantageous for somebody to wrap a token on that network to be able to exchange it through the DEX or participate in the AMM or do other things there.
Mm-hmm.
So XRP is a completely separate ecosystem. They're all independent of one another, but they can be interoperable.
Mm-hmm.
Here's one for you if you want to take it. NFT question. I've had an NFT sent to my ledger via Polygon Network. From what I've read, those are scams.
Mm-hmm.
I haven't tried doing anything with it. What do I need to know or do?
Great question. Thank you for asking. The likelihood, the high likelihood is that it is a scam. You definitely want to make sure that you don't touch it, you don't interact with it at all. It's one of the worst things that I think is kind of like a circumstance of being in the NFT space, is that people can just send you stuff. And it's really tough to not look at it or not know what it is. And some of it looks really cool or part of a project you may not have known about. On like OpenSea or even Magic Eden, you can select some of these and you can hide them, so you never actually see them, which is a nice feature. I've seen them on Solana, I've seen them on Polygon, MetaMask. It's kind of like, somebody offers you a prize, and you won this cruise, and you're like, I didn't even enter the contest. So you just want to make sure, if it's too good to be true, it most certainly is.
Send me 10 XRP and I'll send you 100. Yeah, scam. I'm hopeful that when we do get regulation, a lot of this just tomfoolery, I guess is the best way to put it, goes away. I think there's always going to be Ponzi schemes and other stuff where people try to take advantage of others, unfortunately. Mm-hmm. But, at least there'll be ramifications that are enforceable. Mm-hmm. If we do have regulation in the space and it's governed by, I don't want to say the same laws that traditional finance is, but something similar, right? Mm-hmm. And this is also the problem with public networks. And I say it's a problem. People champion decentralized open network and infrastructure. It can be great in certain applications, but then you have, stuff like this that you want to try to mitigate risks for. So appreciate you answering that, because I would not have known, Matt. Again, the NFT consultant, guys, if you have NFT questions, Matt's your guy. Let's see here. Max says, on the credit side, Self.Inc. has a credit builder that isn't bad.
Nice.
Lots of good questions. Here we go. PayMeAnXLM says, what are some examples of value investments? Well, if you take it out of Buffett's playbook here, you've got Geico, you've got Coca-Cola, and you've got See's Candy. And if he could buy any more of those three stocks, he would still be doing it. Yeah. Those are things that the cost of production is a penny, and they sell them for $1. Mm-hmm. So sticky, cheap to produce, high cost air is what. Go ahead.
One of the mantras is always buy what people love. You want to find good value, buy what people are just going to keep buying over and over and over again.
Starbucks, McDonald's.
Yeah.
You don't have to agree if they're healthy or not, but there's going to be a large consumer base that continues to consume those products in particular, right? Nike, it's a brand. Apple, Buffett's position in Apple is huge.
Like half their portfolio now, or something. Yeah.
And they were late to the game on that one. It's not like they got in early. But I mean, so those are some examples in traditional stocks, right? I look for asymmetric bets. I try to beat other people to investments. If you were talking private equity, again, nothing here is financial advice. I'm just going to echo it again.
Good reminder.
Ripple, I think, is a great value investment. even at a 4.3, 4.5, 5, $6 billion market cap, whatever you can get it for on the private market, if you're an accredited investor, or if you're not, you might check out our mastermind. Anyway, I think that's a great opportunity. They speculate and want to be the Amazon of crypto and financial transactions and payments. Could be $1 trillion company, and if they reach that, if you bought it at a $5 billion valuation, they get to $1 trillion company. It's a good 200x return. I don't think it's gonna be tomorrow when they get to the $1 trillion. Saudi Aramco, they IPO'd at 59 billion. It's the largest IPO that's ever happened, and they're worth, I think, 2 trillion now. So if you bought at the IPO, you made 40x your money. Still, Ripple, I think, could accomplish something very similar. And so, anyway, that would be a good one in private equity. I think there's a lot of commodities, precious metals in particular, that might be good value investments, that are good hedges against potential problems in the monetary system. I don't know what type of real returns you're going to make on those if things got repriced, but I think it would at least hold your value, and you might get some actual ROI in comparison to other things. My normal 3 criteria for making investments, and Matt, I don't think we've ever talked about this, but I'll give you the rundown. I've broken this rule, both 2 rules, just for crypto in particular, but 90% of the time, this is where I'm at. I need ROI, which means I do better than inflation. So real ROI of some kind. Second is going to be cash flow. I want some type of cash flow. It could be dividends. It could be, rental income off of a property. It could be cash flow from a business and distributions, something like that. And then the last piece is I want to be able to take leverage against it, to be able to, take loans at a low interest rate, pull that liquidity back out of things, and then redeploy it somewhere else that generates an arbitrage on the interest there. Right. So those are my normal 3 criteria. I've broken that for for the potential upside, because the ROI, I think, is so high on some of these digital assets, and I think the other 2 will come later, like we talked about. As these financial markets develop and we get regulatory clarity and they build derivatives on these things, I think that you'll get the other pieces after significant appreciation. So, what do you think? What do you think are some current, asymmetric bets or value investments?
I think one of the hardest things to think about is sort of the reporting structure, and the fact that you don't like consistent returns, or what do these companies and tokens earn? What do they make? There's no reporting. So it's kind of tough to value based on how Buffett used to value, which was against book value and looking at what the assets they had, income they were going to generate. So I think, the best value that you're going to see, that the metric that I like to use is, it's kind of a ridiculous one, but at least in this market, how far away are they from an all-time high? What is the multiple by which they are away from their previous all-time high? Have they been, I think staying power is also super important in this space. The longer a token has been relevant, like XRP, for example, it's been relevant for a number of years despite a ton of headwinds and adversity. And you've got to think of it being in a prime position to benefit from that in the future. There are some tokens that didn't go anywhere, or they kind of had their moment and now they're no longer of relevance. So I think one of the ways I like to look at it is like comparing it from an all-time high and how long they've been in the market.
I think those are great. And when you have a speculative market that drives prices, what value is there? And I mean, even like, I'll even talk about XRP or XLM or some of these other tokens that I think will have utility in the future. Currently completely speculative, right? Until we actually have utility on these networks and they're transmitting large volumes of transactions, and there's been issued assets that are being traded in markets. and they're settling through the asset that's native to those networks. Really, I mean, you're speculating.
Right.
And I think the two metrics that you just pointed out are probably the most relevant. There's probably a few others that people could name, but I mean, I think those two are great. There was one I looked at the other day. What was the token? It was WazPay, which is up like a 4x since I made the video.
It's always nice.
I don't know. I don't think I had anything to do with that. Maybe I did. There weren't that many people that watched that video, so I don't think it was me. But anyway, at their all-time high when they released the token was like 96 cents. And it was all the way down to 1 penny. But I've seen HBAR, VChain, all of these other tokens in the last cycle in 20 when I got in. I saw where they ICO'd, and then they came way down from there, 99% drawdown. And then in the next bull cycle, they surpassed where they were launched.
Absolutely.
Right? And so, I mean, you're looking at like a 100x on WazPay if you got it at a penny, if it gets back to all-time high, those are the type of things. And I think to your point, if it's been around through the bear market, it got launched, ideally like 2018.
Yeah.
If it's been around since then, 6 years, it probably has a previous all-time high through 20 and 21. Or maybe at the ICO, and it's been drawn down and suppressed for an extended period of time. That's when you see, when speculation comes back into the market, and we do, at some point, you're going to get people bailing out of Bitcoin into alts, and there's going to be a rotation. And when that happens, that's when you see the craziness that ensues in the alt market. Does that happen before the halving? Probably not, if all constraints remain equal and the same. But it's weird to me that Bitcoin's up this much before the halving. I think it's. I'm going to get flack for this, but I'm going to say it anyway. I think it's a buy the rumor, sell the news type situation. I think so many people understand the market cycles at this point that are in crypto. They're like, oh, just going to repeat the same way it did before. And so you got to run up into the ETF. You got to pull back and a stall. You got to run up into the halving. And then I think you're going to see a big move to the downside before the supply constraint actually kicks in, and you get the actual benefits that provides, and why the halving drives price appreciation. So we'll see. I'm happy to be wrong. I hope it goes to 100,000 and people make millions of dollars. I've got clients that are there, but that's just my speculation.
Yeah.
Can you hang out for another 10 or 15?
I do kind of have to get going. It's a bit late here. I'm just fading looking at the screen. I don't want to follow.
I can tell. That's why I'm asking. Well,
I appreciate it.
Appreciate Lone Wolf becoming a member, and everybody else that asked all the great questions tonight.
Yeah.
Plug whatever you got, man. Let people know where they can find you on social media, and tell them where they can get the book.
Yeah, so the book's available on Amazon. If you have any questions, you can find me on Twitter at Block3Strategy. And it's been amazing just to be able to work with you, Jake, and learn more about the work that you're doing and all the awesome projects that you've got going on. So definitely excited for the future, and we're rocking and rolling, man. This is a crazy time. So happy to be part of it, and just happy to be here. So thanks.
Yeah, appreciate you being on and sharing your knowledge and wisdom with everybody tonight. If you don't follow Matt on Twitter, please go check him out, and I'm sure we'll have him back in the future. But appreciate you this evening, and we'll let you get going, brother. Appreciate you.
Thanks. Travel safe.
Thanks. We'll see you.
Yeah. Take care.